What if the next market crash isn't something to fear, but the biggest wealth opportunity of your life? Because while most investors panic and sell, the smartest money in the world does the exact opposite. And today, I'm going to show you exactly how they win.
You know, market volatility can feel like a storm, right? It sends most investors running for cover. But what if that storm was actually a rare opportunity in disguise? Today, we're going to break down how the pros handle these exact moments and how you can build a portfolio that doesn't just survive the turbulence, it actually thrives in it. So let's get right into it. It's a totally natural reaction, isn't it? The markets take a dive, all the headlines turn red, and you feel that knot of fear in your stomach. The first impulse for so many of us is to sell, to get out before things get any worse. But the professionals, the folks managing these huge funds, well, they have a completely different playbook. And look, that is not an exaggeration. While individual investors were feeling the heat and selling, analysis shows that mutual fund houses did the exact opposite. They saw the market dip not as a crisis, but as a sale, a Black Friday for stocks, if you will, a chance to buy quality companies at a serious discount. Now, get this. The number here is just staggering. They didn't just nibble around the edges. They went all in, deploying a massive 80,000 crore rupees into stocks during that recent downturn. That shows incredible conviction, right? They saw real value where most people only saw fear, and they acted on it decisively. I love this quote from financial expert Dr. Mukesh Jindal because it just hits the nail on the head. He's basically saying these downturns aren't everyday events. They're rare golden tickets. These are the moments where a disciplined investor can potentially accelerate their wealth creation in a way that just isn't possible when the market is just chugging along normally. So how do we flip that switch? How do we go from panic to seeing opportunity? Well, that's what this whole explainer is about. We'll start by really getting that professional mindset. Then, I'm going to walk you through a simple 3-pillar framework to build a rock-solid portfolio. We'll cover diversifying, automating, and optimizing. And we'll wrap up with a super practical 3-step audit you can use on your own investments like today. Okay, so let's get into the core of this whole strategy. Building a portfolio that can handle market shocks isn't about some secret, complex algorithm or trying to perfectly time the market. Nope. It's actually about 3 timeless principles that create a strong, robust foundation for your wealth. Our first pillar is all about looking beyond our own backyard. I mean, we live in a crazy, interconnected world, right? Something happens in one part of the globe and it sends ripples everywhere. A truly resilient portfolio has to account for this. It just can't be totally dependent on the fate of a single country's economy. And this slide just illustrates that shift in thinking perfectly. See, the old way might have been just to diversify within India. You've got your large cap, your mid cap, your small cap. But the resilient way, the way experts are advising now, is to diversify across different countries and even different types of assets. Notice the big additions here: global equity, like the US market, and gold. This creates totally different layers of protection and new avenues for growth. So why is this such a big deal? Well, it boils down to 2 key things. First, when you invest in, say, US markets, you get exposure to the dollar. That can be a great hedge if the rupee weakens. And second, you get a piece of the action in global innovation. I mean, think about the massive tech and AI companies leading the charge worldwide. Diversification gives you a seat at that table. All right, let's move on to our second pillar. This one is all about putting your growth on autopilot with a simple yet incredibly powerful technique. And yeah, you read that subtitle right. This one little tweak could literally be worth 1 crore rupees to you over the long run. It's called a step-up SIP, and the concept is wonderfully simple. All it means is that as your income grows each year, you get a raise, a bonus, whatever, you step up your investment amount by a small fixed percentage, maybe 10%. It brilliantly aligns your saving rate with your earning potential, making sure your investments keep pace with your career. Okay, but here's where it gets really wild. Just look at the math. It's almost unbelievable. So let's say you do a standard SIP of 10,000 rupees a month for 20 years. Assuming a pretty standard 14% annual return, you build a corpus of about 1.3 crore. Not bad. But now look what happens when you add that simple 10% annual step up. The final corpus just explodes to 2.3 crore. That's a 1 crore rupee difference. Just let that sink in for a second. That extra crore didn't come from picking some magical stock or timing the market perfectly, no way. It came from a small, disciplined, automated increase year after year. That's the raw power of compounding mixed with consistent growth. It's incredible. And that brings us to our third and final pillar, pruning for performance. This is all about being an active manager of your own portfolio. Because a truly great portfolio isn't just about what you add to it. It's also about what you strategically remove. It's about cutting out the dead weight, like high costs and funds that do the same thing, to make sure every rupee is working as hard as it possibly can for you. So here's a crucial point, especially when it comes to large cap funds. The data shows it is becoming incredibly difficult for even the smartest active fund managers to consistently beat the market. You pay them higher fees for the chance they'll outperform, but very often they don't. An index fund, on the other hand, is dead simple. It has super low fees, and it just aims to give you the market's return by investing in the top companies. It's a simpler, cheaper, and frankly often a much more effective strategy. Okay, we've covered the 3 pillars of a resilient portfolio. That's the theory. Now, let's make this real. We're going to turn these principles into a simple 3-step audit that you can use right now to check the health of your own investments. Here's our little roadmap for your personal portfolio audit. We're going to check your geography, we're going to check your fees, and we're going to check for overlap. 3 simple checks that line up perfectly with the 3 pillars we just talked about. First question you need to ask yourself. Go ahead, pull up your portfolio statement. Take a look. Are all of your equity funds invested only in Indian companies? If that answer is yes, you might be taking on a lot more risk than you realize. You're missing out on that crucial global diversification. So here's your action plan. Experts recommend adding a global equity fund to tap into markets like the US, and also consider a gold fund to diversify into a completely different asset class. This combination helps your portfolio handle all sorts of different economic storms.
Second step, take a hard look at your large cap funds. Are you holding those actively managed ones? Okay, now check their performance against a simple Nifty 100 index fund over the last, say, 3 to 5 years. And don't forget to factor in their higher fees. Ask yourself honestly, are you really getting your money's worth?
And the action plan here is pretty straightforward. If your active large cap fund isn't justifying its high fees with consistently better returns, it might be time to switch. Moving to a low-cost Nifty 100 index fund can instantly reduce your cost and make sure you capture the returns of India's top 100 companies. And finally, the third check. This is such a common mistake, so don't feel bad if this is you. Do you own like 3 or 4 different mid-cap funds or a bunch of small-cap funds? It feels like you're diversifying, but a lot of the time, it's just duplication. Here's what's probably happening. You could have 4 different small-cap funds that all hold 60 or 70% of the exact same stocks. You haven't really diversified. You just made your portfolio way more complicated to track. The solution? Pick the single best fund in that category, stop the SIPs in the others, and consolidate. Simplify your holdings and clarify your strategy.
So I'll just leave you with this one final thought. Think of your portfolio as a garden, not a warehouse. A garden needs regular care, pruning, weeding, and attention to really flourish. A warehouse is just a place where you collect stuff and hope it becomes valuable someday. So the real question is, are you being a gardener for your wealth, or are you just being a collector?
Because the truth is, market crashes don't destroy wealth. Bad decisions during crashes do. If you want to learn how to think like the top 1% of investors, not the crowd, hit subscribe now. Because the next market crash? It might just be your biggest opportunity.